Imagine a world where the price tag on a product is no longer the deciding factor.
Hmm.
Imagine a global marketplace where who you trade with isn't decided by who offers the cheapest efficiency or, the fastest shipping or the lowest labor costs, but by who is your friend.
It's a completely different logic.
It is. We are entering an era where economics is no longer just about supply and demand curves. It is about national security, it's about friendshoring,
Right.
and it is about a new buzzword that is going to define the next decade:
Hmm.
strategic indispensability.
It really is a massive paradigm shift. We are effectively witnessing the funeral of hyperglobalization as we knew it in, say, the early 2000s, that era where money flowed seamlessly across borders,
Right.
and the rise of what this year's economic survey calls geostrategic globalization.
Geo-strategic globalization. Okay.
The rules of the game have fundamentally changed, and if you are an emerging economy like India, you can't just play by the old rule book anymore. You need a new strategy.
And that's where this chapter comes in.
And that is exactly what Chapter 4 of the Economic Survey 2025-26 is all about. It's titled External Sector, Playing the Long Game, and it is essentially the playbook for how India intends to win in this fractured world.
That is a massive setup, and there is a ton of nuance to unpack here. But before we dive into this ocean of data and strategy, I want to give a massive explicit welcome to all our listeners from the Simplified UPSC by PPP community.
Welcome, everyone.
Welcome to this deep dive.
It is great to have the Simplified UPSC by PPP community with us. This is going to be a dense, high-yield session specifically tailored to help you connect these broad economic concepts to your syllabus.
Right down.
We aren't just reading the news, we are decoding the matrix for your exams.
Absolutely. And listen, we put a huge amount of work into breaking these complex chapters down into something you can actually use for your exams and, your general understanding.
We really do.
So I have a humble request. Please subscribe to the channel. And if you are capable and you find value in what we do, please consider joining the paid membership on YouTube.
It makes a huge difference.
It does. That support is the fuel that allows our team to keep bringing you this super useful, high-density content.
And we have to give a massive shout out to all our existing members. Your support is invaluable. Please hit that like button and share your thoughts in the comments below. We read them, and they help the algorithm find more learners like you.
Also, quick housekeeping before we start the analysis. If you are scrambling for a pen and paper, don't worry. We have free notes with practice PYQs available right now on the Telegram channel.
Go grab them.
The link is in the description. Go grab them. And for our Legend YouTube members, we have something special. The premium notes, which include extra PYQs and model mains answers for those tough mains questions, are waiting for you on the Discord channel. So if you haven't joined there yet, please do.
Those model answers are particularly useful for Section 4 and the conclusion of this chapter, so definitely check those out if you're tackling General Studies Paper 3.
Oh, that's a good point.
It's one thing to know the data, it's another to know how to structure it in an answer.
Okay, housekeeping done. Let's talk mission. Our mission today is a comprehensive line-by-line analysis of Chapter 4 of the Economic Survey 2025-26.
Yep.
We are talking global trade dynamics, India's trade performance, the balance of payments, and the outlook. We are not skipping the hard stuff.
No skimming today. We are going deep. And crucially, we are going to link this directly to past year questions, or PYQs. We want to show you exactly how this material, which can seem dry in a PDF, actually appears in the prelims and mains exams.
Exempting the dots.
We will connect the dots between the survey and the syllabus.
Let's jump in. Section 1, the new global context.
The survey comes right out of the gate saying we are moving away from seamless globalization. We used to think that trade would just keep getting easier and flatter. But the survey uses a very specific word, fragmented. What does that actually look like on the ground?
It looks like walls going up. If you look at the text, the introduction paints a picture of a world where protectionism is taking precedence over open markets.
Supply chains are being recalibrated not because it's cheaper to move them, but because of geopolitical shifts. We are seeing a shift toward bilateralism deals between two specific countries, rather than those big multilateral agreements overseen by the WTO that we used to see in the 90s and 2000s.
So that whole WTO framework, it's losing its teeth.
The WTO, or World Trade Organization, was supposed to be the referee. But in this new context, the players are ignoring the referee. It is struggling to remain the referee, yes.
That seems like a dangerous precedent.
It is. The survey explicitly mentions the weakening of regional and multilateral trade agreements, but it goes deeper into the psychology of the market. It talks about two specific indices:
Okay.
the Trade Policy Uncertainty, TPU Index, and the Global Economic Policy Uncertainty, GEPU Index.
Okay, let's unpack those indices. Because uncertainty feels vague. How do we measure it?
So these indices, they track how often policy terms related to uncertainty appear in media and reports. And here's the scary part. Both of these peaked in April 2025.
Just recently.
Yes. That is a concrete data point showing that businesses and governments are more unsure about the rules of trade than they have been in a long time.
So when the TPU index spikes, it means corporate boards are sitting there asking,
Can we actually ship this product next month? Or will there be a new tariff? Will there be a sanction?
exactly.
And what is actually driving this uncertainty? Is it just the visible conflicts we see on the news?
Conflict is part of it, for sure. Specifically, the ongoing situations in Eastern Europe and Western Asia. These disrupt physical logistics.
Of course.
But the deeper drivers are structural. It's industrial policies. That's a polite way of saying countries are subsidizing their own industries to compete unfairly.
Protectionism by another name.
Precisely. It's the intense competition for rare earth minerals, which are effectively the oil of the 21st century.
Rare earths, you mean the stuff that goes into batteries and chips?
Exactly. Lithium, cobalt, nickel. Nations are realizing that if you don't control the minerals, you don't control the future of tech.
And finally, it's the migration of national security tools into trade policy. When you start blocking exports of semiconductors or specialized machinery because of national security, you are fundamentally changing the nature of trade.
It's no longer just business.
It's defense.
That brings us to that term you mentioned in the intro, geo-strategic globalization. That sounds like a heavy academic term. Break that down for us.
Right. So geostrategic globalization means that trade isn't stopping. People still need to buy and sell things. The volume is still there.
Yeah.
But every trade deal is now scrutinized through the lens of political allegiance. The survey uses chart 4.1 to illustrate this beautifully. It tracks trends in friendshoring and nearshoring.
Okay, definitions time. Friendshoring is trading with your political allies, your friends.
Yep.
And nearshoring is trading with your geographic neighbors.
Exactly. It's about reducing the length of your supply chain or moving it to a place you trust. And the data shows a massive resurgence in friendshoring in CY 2025.
A resurgence.
A huge one. Countries are actively shifting their supply chains to nations that share their political values. It's a trust-based trade system. At the same time, we are seeing trade concentration increase.
Trade concentration, what does that mean?
It means the big economies are trading more with each other and leaving the smaller players out.
It's becoming a club.
It's becoming a club. If you aren't in the club, or if you aren't a friend to a major power, you get left out in the cold.
Which sounds incredibly dangerous for developing nations who might not be in the club.
It is a significant risk, but it also creates opportunities if you can position yourself as a friend to multiple blocs, which is essentially India's strategy.
A balancing act.
A very delicate one. But let's look at the growth numbers. What does this fragmentation actually do to the global wallet?
The forecast in the survey doesn't look great.
It doesn't. The IMF data cited in the survey shows global trade volume growth is slowing down. It was 3.6% in CY 2025, but it's projected to drop to 2.3% in CY 2026.
That is a significant slowdown.
It is. It means the pie isn't growing as fast as it used to.
And is everyone hit equally by this shrinking pie?
No. And this is an important distinction for our listeners, especially for your GS Paper 3 answers.
Okay.
Emerging markets and developing economies, EMDEs, are actually expected to grow their trade volumes faster than advanced economies, or AEs.
That sounds like good news for us.
On the surface, yes. But the survey adds a caveat. EMDEs are also much more vulnerable to policy uncertainty. When the US or EU changes a tariff rule overnight, it hits an emerging economy much harder than it hits another advanced economy because the emerging economy often lacks the buffers to absorb the shock.
So we're growing faster.
But we are also walking on thinner ice.
Okay, so the global waters are choppy, the weather is bad, the pie is shrinking. But here's where it gets really interesting. Despite all this global chaos, the survey says India is actually hitting records. Let's move to section 2. Trends in India's trade performance.
This is the resilience story. While the world slows down, India's total exports, and remember that's merchandise, goods, plus services reached USD 825.3 billion in FY25.
Let that number sink in. 825 billion.
It is a massive number. That is a 6.1% growth year on year. And crucially, that momentum continued into FY26.
So it's not a blip.
Every quarter in FY26 so far has seen record export levels for that specific quarter. It suggests that this isn't a fluke, it's a trend.
That is impressive. But is it just because we are selling to everyone indiscriminately, or is there a strategy here?
It's because we are diversifying. The survey cites data from UNCTAD, the UN trade body, showing that India ranks third in the Global South for the diversity of its trade partnerships.
Wait, third in the entire Global South?
In the entire Global South, we are right behind China and the UAE.
That's a big deal. It means we aren't putting all our eggs in one basket.
Precisely. If one market puts up a tariff wall, say the US or the EU, we have others, that diversity index score of 3.2 is actually higher than many global north countries.
So we're resilient.
We are resilient because we are connected to a wide network. We are building redundant systems in our trade network.
Let's break down the trade basket, though, because total exports hides a lot of detail. Let's talk about goods merchandise trade. This is usually where we struggle.
This is where the picture gets nuanced. Merchandise exports were steady at about $437.7 billion in FY25. They didn't grow massively. They essentially maintained their ground.
Yeah.
But imports rose to $721.2 billion.
Which means we have a deficit, a pretty big one.
Yes. The merchandise trade deficit widened to $283.5 billion. Now, I know when people hear deficit, they think it's inherently bad.
Right, panic button.
But before we panic about the deficit, we need to look at what we are importing and exporting. The drivers tell the real story.
Okay, let's look at the export drivers first. Petroleum products were actually down, right?
Yes, down 24.7%, mostly because global oil prices softened. Remember, India imports crude oil, refines it, and exports the petroleum products.
Right, the value add.
So when global prices drop, the value of those exports drops, even if the volume stays similar. But look at what went up.
Tell us the winners.
Telecom instruments grew by a massive 51.2%.
Wow.
And drugs and pharmaceuticals grew by 11.2%. This is a structural shift. We aren't just selling raw materials or refined oil. We are selling high-tech manufacturing and complex biology.
And the telecom growth is the make in India for phones.
It's directly linked to the rise of smartphone manufacturing in India. Absolutely.
And on the import side,
Yeah.
why did our bill go up so much?
Well, the big drivers were petroleum crude standard for us and gold. Gold imports shot up 27.4%.
Because Indians love gold. We just can't help ourselves.
It is partly cultural domestic demand, festivals, weddings, but also global prices went up nearly 38% due to geopolitical uncertainty. Gold is a safe haven.
Okay, makes sense.
But here's the key analytic point the economist in me loves. We also saw a huge jump in imports of electronic components.
Now, usually we say imports are bad. Why is importing electronic components a good thing?
Because of what you do with them. If you import a finished phone, that's consumption. Money leaves the country and you get a gadget.
Right.
But if you import electronic components, it means you are assembling and manufacturing the phone here in India to sell it globally.
So it's an input.
It's a productive input. The rise in imports of intermediate goods is a leading indicator of manufacturing strength. It means the factories are humming. It means value addition is happening on Indian soil.
That connects perfectly to a past year question. I think we have a linkage here.
We do.
Oh.
This connects directly to 2013 prelims Q83. That question asked about what constitutes India's foreign exchange reserve and import composition.
Wow. Classic.
A total classic. Understanding the breakdown of our import bill, petroleum, gold, capital goods is a recurring UPSC theme. The survey is giving you the current data for that exact concept.
So this is how you use the survey.
Exactly. If you know that petroleum and gold are our biggest import items, but that capital goods and intermediates are rising, you can answer questions about the current account deficit and industrial health much more accurately. It allows you to argue in mains that our deficit is productive rather than just consumptive.
That's a great distinction. So gold and oil are the usual suspects, but the electronic components are the new plot twist indicating manufacturing growth.
Precisely.
Speaking of which, let's talk about the sector that employs the most people, but often gets overlooked in these high-tech discussions. Agriculture.
Agriculture is fascinating because of the massive gap between potential and reality.
How so?
India is the second largest producer of agricultural products in the world. We are a farming giant, but, and this is the statistic that should wake you up, we only command 2.2% of global agricultural exports.
That seems incredibly low, 2.2%, for a country that is the second largest producer.
It is. It shows a massive untapped potential. We are feeding ourselves, which is food security, and that's great, but we aren't capturing the global market value yet.
We're not moving up the value chain.
We aren't processing enough food. We are selling raw mangoes instead of mango pulp or juice, where the profit margins are. The survey highlights this disconnect as a major area for policy focus.
And what about the PLI schemes? The production-linked incentive schemes? The government has bet big on these paying companies to manufacture here. Are they paying off?
So the survey gives us a report card, and it's a mixed bag, or rather a K-shaped success.
Two-shaped, okay.
For high-tech sectors like electronic goods, the PLI is a massive hit. Exports in that sector have a HAGR, compound annual growth rate, of around 50%.
50%, that's explosive.
That is explosive growth. Pharma is also doing well.
But, there's a but.
But traditional sectors like textiles and food products show only moderate growth. Textiles grew at about 7.8%. The takeaway here is that PLI is highly effective for jump-starting new high-tech industries where companies are looking for an alternative to China.
Right.
But revitalizing mature, labor-intensive industries takes more than just incentives. It takes structural reforms in labor laws and logistics.
That brings us to a metric I found really intriguing, the Economic Complexity Index, or ECI. This sounds like something out of a sci-fi novel. What is it, and why does the survey care?
It's a brilliant metric developed by Harvard. It measures the knowledge intensity of an economy. Basically, think of it this way. Do you export simple things like raw cotton, or complex things like jet engines and microchips that require huge amounts of collective know-how?
So how complex are we?
India ranks 44th. Now, that is an improvement from where we were in 2013, but, and this is the concern, we have been stagnant since 2019. We haven't moved up the ladder in the last few years.
So we are stuck at 44. Why?
We rely heavily on refined petroleum and diamonds for our export numbers. These aren't complex in the same way advanced machinery is. The survey's message is clear. To become a true economic superpower, we need to make more complex things. We need to move from 44 to the top 20.
We need to embed more knowledge into our products.
Exactly.
Diversification seems to be the strategy to get there. You mentioned we were trading with more countries.
Yes, look at chart 1.9 in the survey. It shows a fascinating trend. Exports to the U.S. in labor-intensive sectors actually dipped recently, but exports to the rest of the world grew. We are actively decoupling from over-reliance on the U.S. market for certain goods.
And we are signing new deals to lock this in.
Exactly. The India-UK CETA, the India-Oman CEPA, the EFTA deal, these aren't just acronyms. They are highways for Indian goods to bypass trade barriers.
The Oman deal is interesting.
It's particularly strategic. It gives us a gateway to the Middle East and Africa.
Okay, so merchandise trade is a story of holding the line and strategic shifting. But now let's talk about the superstar, the hero of this story, services trade.
This is the stabilization anchor. Without services, our balance of payments would be in serious trouble. Services exports hit an all-time high of USD 387.5 billion in FY25.
And the surplus, that's the key number.
The surplus was $188.8 billion. To put that in perspective, that surplus pays for 2/3 of our entire merchandise trade deficit.
That is incredible. So for every dollar we lose buying oil and gold, services earn us back 66 cents.
Exactly. It's the financial firewall of the Indian economy. If our services sector sneezes, the whole economy catches a cold. But right now, it is roaring.
And what are we selling? Is it just call centers? I feel like that's the stereotype people still have. Someone asking, have you tried turning it off and on again?
That stereotype is 20 years old. It's not call centers anymore. It's global capability centers, GCCs.
Unpack that for us. What is a GCC?
Imagine a massive multinational, say a bank like JP Morgan or a tech giant like Google. Instead of outsourcing their back office to a third-party vendor, they build their own office in Bangalore or Hyderabad. But it's not just back office work. They are doing R&D, they are doing high-end accounting, legal services, software development, AI training.
So we move from help desk to headquarters annex.
Perfectly put. India is becoming the office of the world. Business services and software are leading the charge.
And this must have a PYQ connection.
It connects to a broader mains theme. Think about 2013 GS3Q7, which asked about the impact of liberalization on Indian companies. The explosion of GCCs is the modern answer to that question.
How so?
Liberalization allowed this integration, and now Indian talent is driving global corporate strategy from Indian soil. We aren't just following orders, we are designing the products.
That is a powerful shift. Now let's zoom out to the big picture accounting. Section 4, the balance of payments, BOP.
This is the macroeconomic heartbeat. If this stops, the economy stops.
Let's start with the current account deficit, CAD. We hear this term on the news all the time.
Yeah.
CAD is widening, CAD is narrowing. What is the status?
First, a quick definition for our listeners. CAD is essentially your merchandise trade deficit minus your services surplus and transfers.
So it's the net check we write to the world.
Exactly. It's the final tally. And are we bouncing checks? No, we are very safe. The CAD is manageable at 0.8% of GDP in the first half of FY26.
0.8%. That sounds low.
It is very healthy. The generally accepted safe limit is around 2.5% to 3%. So we are well within the comfort zone.
And compared to other countries?
Chart 4.33 compares us to our peers. New Zealand has a deficit of negative 7.7%. The UK is at negative 1.8%. We are looking very prudent by comparison.
A big reason for that prudence is something you mentioned earlier, transfers, or more specifically, remittances.
This is a staggering stat every time I see it.
It is.
India is the world's largest recipient of remittances. We received USD 135.4 billion in FY25.
$135 billion. That is money sent home by Indians working abroad.
It's a massive amount of capital. To give you scale, that is more than the GDP of many countries. And here's the kicker. Remittances consistently exceed FDI inflows.
Wait, really? We get more cash from our workers abroad than we do from foreign companies investing here.
Consistently, and unlike foreign investors who might pull their money out if the stock market crashes, remittances are stable.
They're more reliable.
They are counter-cyclical. When things get tough in India, like during the pandemic or a recession, families abroad send more money, not less, to support their relatives.
That is a great point. It's like a national insurance policy provided by the diaspora.
A perfect analogy.
But speaking of foreign direct investment, or FDI, let's talk about the capital account.
Right. We need to distinguish between FDI and FPI. This is crucial for your prelims.
Okay.
FDI is foreign direct investment long-term, building factories, buying companies. It's like a marriage. It's hard to get out of. You are committed.
Got it.
FTI is foreign portfolio investment buying stocks and bonds. That's like dating. You can break up via text message instantly.
Hot money versus patient money.
Exactly. FDI trends show that gross inflows are rising, which is good.
Yeah.
But global competition is fierce. Why? Because interest rates in the West are high.
So there's less incentive to take a risk here.
If you can get a guaranteed 5% return in U.S. bonds, why risk investing in a factory in a developing market? That's the headwind we face.
The survey has some interesting boxes on this, box 5V.2 and IV.3.
Yes. They discuss returns on inward FDI. It turns out investing in India is profitable, but box 4, 1.3 is crucial. It talks about the need for India to be a connector country, like Vietnam.
A connector country, explain that.
Look at Vietnam. They import parts from China, add value, and export to the U.S. They act as the bridge between the two rivals.
So they play both sides.
They become a critical link in the supply chain. India needs to play that role more aggressively. We can take Chinese components, use Indian labor and tech, and sell to Western markets.
And we're also seeing outward FDI Indian firms investing abroad?
Yes. Indian companies buying assets in the UK, Oman, Africa. This is a sign of economic maturity. We aren't just a destination for capital, we are a source of capital. We are buying mines, ports, and brands abroad.
This whole discussion on FDI and supply chains screams mains questions.
It does. Look at 2013 GS3 Q9A and Q9B. They asked specifically about FDI and retail and supply chain management. The arguments haven't changed, just the context.
It's relevant.
And for prelims, look at 2022 prelims Q8 regarding indirect transfers. The definitions of what counts as FDI versus FPI are always fair game. Understanding the volatility difference between the two is key.
Okay, moving on to Section 5. We have talked about trade and investment. Now let's talk about the war chest. Foreign exchange reserves.
We have a fortress. Reserves stood at USD 701.4 billion in January 2026.
$700 billion. That is a hard number to wrap your head around. What does that actually buy us?
It buys us security. That covers 11 months of imports.
Wow.
If the world stopped trading with us tomorrow, total blockade, we could buy what we need for almost a year. It also covers 94% of our external debt.
That is a huge comfort factor.
It is. And connecting to 2013 prelims Q83 again, remember, reserves aren't just U.S. dollars, it's a basket.
Right.
It includes foreign currency assets like U.S. Treasury bonds, gold, SDRs, special drawing rights from the IMF, and the reserve tranche in the IMF. You need to know those 4 components for the exam.
And they'll try to trick you.
Often, they will give you a multiple choice question and try to trick you by adding Government of India bonds or something else that isn't part of Forex reserves.
Noted. Now let's get a bit technical. Box 5E.5 talks about exchange rate dynamics. This is one of those topics that confuses everyone. Does a weak rupee help us or hurt us?
It is the million-dollar question, isn't it? The survey tackles this head-on with an econometric analysis. There are 2 channels here. First, the trade channel. A weak rupee makes our exports cheaper for foreigners, so they buy more. And it makes imports expensive for us, so we buy less. This improves the trade balance.
Okay, so weak rupee, better trade balance. Simple enough.
But wait, there is the financial channel. If the rupee is weak, paying back dollar-denominated debt becomes much more expensive. That hurts corporate balance sheets.
Right, if you borrowed in dollars.
If a company borrowed $100 million when the rupee was at 80 and now it's at 90, they owe significantly more in rupee terms.
So it's a tug of war. Which side wins?
The survey's verdict is clear. For India, the trade channel dominates.
Oh, really? That's a big statement.
It is. Because our merchandise trade is highly responsive to price, economists call this elastic, the benefit we get from boosting exports and curbing imports outweighs the pain of debt servicing.
So the conclusion is,
a weaker rupee is net beneficial for the balance of payments.
That is a counterintuitive takeaway for many who think strong rupee, strong nation.
That strong rupee sentiment is politics, not economics. And this leads us perfectly to box 3.6, the East Asian lesson.
The East Asian Tigers.
This box is a history lesson. It looks at Japan and South Korea. Did they have strong currencies when they were developing in the 70s and 80s?
I assume they did. That's the image we have.
No. They kept their currencies undervalued to boost exports. They became manufacturing powerhouses first. They didn't get a strong currency by playing financial games.
They earned it.
They got it by making cars and electronics that the world couldn't live without.
So the lesson for India is,
currency stability must come from export competitiveness. You can't artificially prop up the rupee with interest rates forever. You have to build the factories. If you make good stuff, the currency credibility will follow. Don't put the cart before the horse.
That connects to 2022 prelims Q2 about NEER and REER.
Yes, nominal effective exchange rate and real effective exchange rate. The divergence between them tells you about your competitiveness. The survey discusses this explicitly. If your inflation is higher than your trading partners, your REER goes up, hurting competitiveness, even if your NEER is stable.
So domestic inflation can wipe out your currency advantage.
It eats away your export advantage. It makes your goods more expensive in real terms.
Okay, section 6. External debt. Are we borrowing too much?
Short answer, no. External debt is $718.2 billion.
That sounds like a lot.
It sounds like a big number, but you have to look at it as a percentage of GDP. It's only 18.4%.
And that's low.
That is very low by global standards. Many developed nations have debt-to-GDP ratios over 100%.
Okay, good perspective. And what about our position as a debtor versus creditor?
We are a net debtor, meaning we owe more to the world than the world owes us. This is reflected in the net international investment position, NIIP. However, our assets abroad are growing fast. We are slowly closing that gap.
So we're maturing.
We are becoming a more mature player in the global financial system.
So we have covered the context, the trade, the BAP, the Forex, and the debt. Section 7 brings us to the conclusion and outlook. How do we wrap this up? What does it all mean?
The summary is, the external environment is tough. Geopolitics is messy, tariffs are rising, but India has built buffers.
The firewalls.
We have the reserves, the services surplus, and the remittances to withstand the shocks. We are in a sweet spot compared to many other emerging markets.
But we can't just survive shocks. We want to grow. What is the way forward? The survey lays out a mission.
This is the most critical part of the chapter, I think. The survey proposes a shift in mindset. We need to move from import substitution to strategic indispensability.
Strategic indispensability. I love that phrase. Unpack it.
Import substitution is defensive. It says, let's make this here so we don't have to buy it from them. It's fearful.
Right. Building walls.
Strategic indispensability is offensive. It says, let's make something so critical, so complex, that the world cannot function without buying it from us.
Like Taiwan with semiconductors.
Yes.
You can't run the modern world without them.
Exactly. You become indispensable. To do that, the survey says manufacturing is non-negotiable. We cannot rely solely on services.
We need to make things.
We need to make things. We need to be part of the physical supply chain of the world.
And to make things, We need to fix the basics.
Reduce logistics costs. Correct inverted duty structures, where taxes on raw materials are higher than on finished goods, which discourages manufacturing.
Classic problem.
A huge one. And we need FDI not just for the cash, but for the technology. We need to plug into global value chains, GVCs. We need to be the factory floor for the world, not just the back office.
So the mission is clear. Stop playing defense, start playing offense. Build things the world needs.
And that leads to a final provocative thought for our listeners.
Yeah?
The survey implies something fascinating about geopolitics. In a polarized world, U.S. versus China, West versus East neutrality might actually be an economic asset.
How so?
If you are aligned with only one side, you lose half the market. But can India use its unique position trading with both the global north and south, being a connector country, to become the ultimate economic bridge?
So can we trade with Russia, the U.S., Europe, and the global south all at once?
Can we? Or will the pressure to pick a side eventually stall our growth? Can we really play the long game without picking a team?
That is the question to ponder. Can we be friends with everyone and indispensable to everyone?
It's the billion-dollar question, and the answer will define the next 25 years of the Indian economy.
Well, on that note, we have reached the end of our deep dive into Chapter 4. I hope your brain is buzzing with data and strategy.
It was a pleasure unpacking this. This chapter really is the roadmap for the next decade.
Before you go, a final reminder. If you found this deep dive valuable, please subscribe and join the paid membership on YouTube to support us.
It really makes a difference.
It does.
And don't forget to grab the free notes and practice PYQs on our Telegram channel. And for our Legend members, the premium notes with Model Mains answers are waiting for you on Discord.
Go get them, study hard, and we will see you in the next deep dive.
See you then.